Glad to be here with you today. Due to the market environment lately, it's been so much riskier to trade in this environment. And from our members, we've had a lot of questions regarding, how can we trade a little safer in this type of environment? What are the things we can do? And some very quick and easy answers are you can reduce your size in this kind of environment. You can back off a little and trade a lot less. But when it comes to options, we always say you have a lot of options with options. And one strategy that can really be a lot less risky, can really help in this type of environment, are debit spreads. And that's why I thought I'd do a little segment on debit spreads today. So, first of all, for those of you who are joining us for the first time, a bit about us here at Trading Wins. We are a group of pro traders with well over 30 years of experience. We are real traders and teachers, and we've been developing our own strategies and systems and teaching people from complete beginners to experts around the globe. Now, in today's presentation, I am still going to go over my money management rules, which I do every time I do a presentation on one of my strategies. But this is key no matter what strategy you're using. So again, to help you in this environment, I'm going to quickly go through our money management rules. Then I will talk about the three types of debit spreads, the pros and cons, and if I can get on my Thinkorswim platform, we'll go through a few trade examples together this morning. They were doing some scheduled maintenance, so I'm not sure if I'll be able to get on, but we'll try. And then, of course, I will hopefully have time to answer as many of your questions as possible. Please do remember that trading can be extremely risky, so do not trade with real money until you are completely comfortable with the method you are using. So, quickly, our money management rules. First one, you've heard a million times, I'm sure, but it is worth repeating. Do not trade with money you can't afford to lose. But what this is really about is trading with an amount that's small enough that it feels completely insignificant to you. Trading is so much more about how you manage a position once you're in it than it is about selecting that entry. And once you're in that trade, you really do need to remain calm, think clearly, and manage your way through that trade. And if you're worried about the amount of money you have in that trade, you simply won't be able to do that. So please remember to trade with an amount small enough that it feels completely insignificant to you. Also, you should never risk more than 5% of your account balance in any one trade. And if you have a larger account, please consider reducing that to 2.5% or even 2%. That way, you'll still have a sizable trade on, but you'll be reducing your risk considerably. Also, you should never have more than 50% of your account balance active in the market at any one time. Now, I usually get challenged on this, but the real reason is twofold. Number one, there's so many factors when it comes to the markets that are completely out of our control, and any major news event can really drive the markets against you and cause you to take a sizable loss. So, number one, this rule is meant to reduce such a loss should it happen, but should it, you'll then have half your account still available to put back into the markets and make back such a loss, okay? And lastly, you should really spread your trades out. Be very, very selective and choose the one or two highest probability trade setups per time frame. Now, we have seen extreme volatility in the markets lately. There have been many, many days where the markets were up strongly one day and then completely retraced the next day. Well, when the market trends strongly one way or the other, you're going to get a number of setups in that direction. So if you jump in and put on 5, 6, 7 trades in that direction, and then the very next day completely retraces on you, you'll find yourself in a huge hole. And that's exactly what this rule is meant to avoid. Okay? Be very, very selective. Choose the one or two highest probability setups per time frame. Okay? A couple of other sayings that we live by here is you will never go broke taking profits. Now, we are very risk averse, and we limit our losses significantly. So even with small profits, we're able to consistently be profitable. But this is really meant for the beginners. If you're just starting out with trading, as you gain more experience, you will learn how to remain in the trade a little longer each time. Okay, but until that happens, when you do have a profit, especially in this type of market environment, you want to take it. Okay, and always remember that trading is never about whether you're right or wrong. That's important. Okay, but it is all about how much money you make when you're right versus how much money you lose when you're wrong. So let's talk a bit about debit spreads. Now, there are three types of debit spreads. There are vertical spreads, there are diagonal spreads, and there are calendar spreads, otherwise known as horizontal spreads. Okay? Today's presentation, I really want to focus on the first one here, vertical spreads. Okay? So, vertical spread is constructed by using options of the same class, the same underlying security, same expiration month, but with different strike prices. For example, we could buy an Apple October 110 call and then sell an Apple October 115 call. Okay? So it's just a straight, one long, one short vertical debit spread. Okay? Diagonal spreads are constructed very similarly, just a slight twist. Okay? These ones have the same underlying security, but different strike prices and different expiration dates. Okay? So in other words, what we can do here is we can buy that same we can buy the November 110 call, but this time sell the near-term month, the October 115 call. Okay? In the hopes that we either and that short call in October expires worthless, and we still have the November calls, and then we can flip it into a regular debit spread by selling another call against it. But we are protected by that higher strike price. So should the stock shoot higher and exercises, we'll still be in a nice profitable position. And then, of course, calendar spreads, otherwise known as horizontal spreads, are constructed using options, again, of the same underlying, but this time same strike price with different expiration dates. Okay? So, calendar spread, an example of that would be to buy the Apple November 115 call, and again, sell the near-term month, but this time the same strike. Okay? You sell the same October 115 call. Really, what you're doing with a calendar spread is you're expecting Apple to get above 115, but you expect it to take some time. You don't expect it to do that right away. So you're selling the near-term option at that same strike, hoping it expires worthless, and subsidizing part of your costs for the long call that you really wanted for November, where Apple should get above that 115. Okay, let's talk about the verticals, though, the straight vertical spreads. So this is a strategy that's perfect for small accounts. Okay, it costs a lot less than just buying a long call or a long put. So it's a great strategy for not only being able to afford it with a small account, but also to grow that account consistently. Okay? Because what you're doing is you're actually using the market's money to pay for most of that trade by selling that short call. Okay? This allows you to reduce your risk as well as increase your probability of profit. And I'll talk a bit more about that in a few minutes. So basically, it's a low-risk option strategy for consistent income. And it's a very overlooked strategy. So it consists of buying a call option and selling another one at a higher strike price to pay for the cost of that. So in other words, by doing so, we're reducing our break even. Okay? And the spread will profit if the stock moves higher, okay? Just like a long call would, okay? Except it will only do so up to that point where the short call caps the gains. Okay, so unlike a long call, this does cap your upside, but it allows you to reduce the cost, reduce your risk, and more importantly, increase your probability of profit on that trade. And there are, believe it or not, ways where you don't necessarily have to cap your upside. I'll touch on that a little later as well. Or if you're going short, what you want to do is buy one put option and sell another one at a lower strike price to help pay for that. Again, to reduce that break even, reduce your risk overall. And in this instance, the spread will profit if the stock price moves lower, okay, just like a long put strategy would. Okay, again, up to the point where it surpasses that short put strike and it caps the gains. Okay, hopefully I'll get a chance to show you on the option chain on Thinkorswim. So the main benefit of this is that not only does it allow you to profit from a gain in the underlying stock price without the large upfront capital outlay. Imagine buying 100 shares of Apple at 115 versus one option contract, right? But it also eliminates that downside risk that you would have with that stock ownership. Okay, the risk is capped; it's limited to the cost of your spread. So your max loss on this is very limited. The worst thing that can happen with this position is for the stock to be below your lower strike price at expiration, your long strike price. Okay, so in that case, both the long and the short call will expire worthless. Okay? And that means you've taken a total loss on that position, which was your net debit to begin with. So it's always, your maximum loss is always what you pay for the spread, nothing more. No matter what happens, the stock can go to zero. You will never pay more than, or lose more than what you originally paid to open that spread. Your maximum gain is capped at the expiration if that stock price is at or above the higher strike, okay, that short strike at expiration. Okay? So in theory, what would happen here if it went beyond that is your short call would get exercised, but you would have the long call to exercise and deliver that stop with you. But we don't want to ever have that happen. We'll just close up the spread before that happens. Okay? Now, a break even here is when the stock price is above the lower strike, the long strike at expiration by the same amount as the debit. Okay, so the short call would expire worthless, and the long call's intrinsic value would equal the debit. Okay, give you a quick example. If you had bought that Apple call at 110 and sold the 115, and it had cost you $2, your break even would be the 110 long strike plus the $2. Your break even would be 112. So if Apple closed at 112, it would be a break even. Okay? So the long strike plus your net debit is always your break even. A very simple, easy calculation you can remember and do in your head. Okay? Now, when it comes to time decay, time erosion usually hurts your position. Okay? But in this case, not as much as it does with a long call position. Okay? Since the strategy involves both a long call and a short one, okay, the positive theta decay from the short call usually offsets most, if not all, the negative theta decay from the long call. And I'll show you how to set these up where you can actually start off your position with a positive theta decay, which is huge. Is there a risk of assignment? Sure there is. There's always a risk of an early assignment. But while possible, usually it doesn't occur unless the price of the stock moves above the strike price and does so by the amount of your debit. Okay? But regardless, you're always covered or protected by that long call option. So not only can you get into this with less cost, okay? it's less risk is the real key here, and especially in an environment like this, that's exactly what you're looking for. So what's your risk if you hold until expiration? Okay, so the risk might be that on that Friday of expiration, it's right near that short strike. So you might not know for sure whether you will have been assigned on that contract. Okay, so and here's the risk: if you don't close out your position before the end of the day, and you end up being assigned on the short strike, but your long call has expired worthless, then you may end up with the stock. Okay, so what you always want to do is make sure that you avoid that assignment, and that if you're anywhere near or think there's any chance of being assigned, that you close that position out, okay, before the end of that day. So why would you use a spread instead of just buying a call or buying a long put? Okay. Well, a spread almost always makes more money. Why? Because not only does it have less risk, but the real reason is because you've reduced your break-even price. Okay, and I'll show you this on the chart. Okay, because you're selling that further out of the money option, it helps you pay for the more expensive option and reduces your cost basis. A lot of times you're putting these on and immediately starting off with a cost basis that's lower than the current price of the underlying stock. So you automatically have a buffer there. Even if the stock pulls back a little after you open the position, you still got a bit of a buffer before you get to that break-even point. And that's the real nice part. Now, what's the worst thing that can happen if I put this spread on? Well, exactly the same thing as when you go along. The worst case scenario that can happen to you is that you lose your debit. In other words, what you paid for the spread. Okay? The amount of money you put up to buy the spread is the maximum you could ever lose. And that's the nice thing. You can sleep at night with these and not worry no matter what happens. You know that your risk is defined. Is the audio okay? I have a couple of people commenting on the audio. Can you hear me better this way? Is it okay? Yeah? Okay. Excellent. We'll continue then. So how much money do I need for this strategy? And this is another one of the things that I like the most about this strategy. It's absolutely none. Okay? So again, with a smaller account, you don't have to worry about how much money you need, margin you need, or ever worry about having a margin call. Okay? Because it's again, it's the same as going long an option. Okay? All you're doing is paying whatever it costs to get into that position. You never have any more at risk. Okay? A real key there. So what's the downside? Well, the downside, even though these days it's pretty much insignificant, is higher commissions. Okay? Because you've just added another contract there, and if you're trading multiple contracts, let's say you usually buy 5 or 10 long calls or long puts, now you're writing another 5 or 10. So overall, your commissions will be higher. Okay? But again, these days commissions are so inexpensive, it's pretty much insignificant. So before we get to look at a couple of examples on the charts, let's talk about the overall benefits. And I know I've mentioned many of them already, but these are key to remember because when it comes to trading, there's so many different option strategies you can employ with or without the underlying stock. And they all vary from when you should be using one versus another. But this is the kind of strategy you can pretty much rely on year-round, and specifically on or with certain events that I'll touch on a little later as well. But the real keys here are that these trades, they're not only easy to put on, they're very, very simple to keep track of. it's so much more difficult to keep track of just a long call or a long put, because if that stock starts moving against you, you really want to either adjust that position or repair it right away. This, with the benefit of that short call, losing value, okay, and allowing you to bank that part of the spread, really gives you extra time to think and adjust this trade, okay? The other benefit is, since it's costing you less, you can buy more contracts. So when it moves in your favor, your profits will be even bigger. So with a smaller account, again, you can buy more because you're spending less. If you would normally buy that Apple 110 call, say for $5, but by selling the 115 call against it, you're reducing your cost, say to $250, okay? Now you can afford to buy 2 calls with the same amount of money that you would have originally been able to buy just 1 call, okay? They also offer more flexibility. As I said, when it comes to options give you, you have a lot of options with options. And hopefully we'll have some time to touch on adjustments and repair strategies, but there's a lot you can do with these to even reduce your risk even further. Okay? As I mentioned earlier, many times you can put these on with positive theta, okay? And especially when we get into the diagonal spreads and you're selling that nearer term option, it's going to erode a lot quicker. It has less time to expiration. The theta is accelerated, and it's a real benefit for these setups. It allows you to stay in the trade longer, as I mentioned, okay? And many times you don't need a stop loss order. So a real benefit here, especially for those of you just starting out, I've coached thousands of students, and the one common thing that I see is the lack of discipline, or the lack of being able to follow those rules to a T when a position starts going against you. It's much easier to follow when it's going your way and you're profitable and more relaxed. But when you start losing money, can you actually, maintain that stop, or do you start moving it around or second guessing yourself? Well, this kind of takes care of that for you. Because you sold that call and you've already reduced your cost, wherever your stop loss would have been on just a long call, chances are you're risking even less with the debit spread than your original stop loss would have been. So you don't, in most cases, don't even need a stop loss order. Okay? A few other benefits: it really gives you the gift of time with the long strike, okay, while taking advantage of that theta decay, that short strike, at the same time. Okay, when you can put on a credit spread, you can sell a credit spread, or you can go long an option, right? Two different things, but the credit spread, you would do so with a very short time to expiration because you want it to expire with it. You want to collect that time value, part of the option. And your long call, you want to go further up because you want to give yourself time for that stock to make its move. Well, this gives you both all in the same strategy, okay? So you can leg into the spread to further reduce your risk and increase your profit. So in other words, let's say you bought that 110 call option on Apple, okay? Well, you don't need to sell the 115 against it right away. If you're very confident in the system you're using and your charts are telling you that Apple's going to make a run, well, once it does make a run, if it moves in your favor, now that 115 call is going to be worth a lot more than it was when you initially opened your 110. So not only has your 110 call appreciated in value, but now you can sell that 115 against it and bring in even more money, okay? That's how you can further reduce your risk and maximize your profits. These are actually very easy to adjust and repair. Again, hopefully we'll have a chance to look at a couple. And you can trade these both ways if you're not really sure which way the stock will move. Many people try to use straddles and strangles, especially ahead of earnings announcements. Well, this way you can put a call debit spread on, you can put a put debit spread on, just like you would for a straddle to cover both sides. But by doing so with debit spreads, it's going to cost you less, and you're going to have less risk overall. Okay? A real benefit. So, what's your biggest enemy in trading? It's the gap. It always has been, always will be. That's your biggest enemy when you're trading. Well, by having that short strike, again, paired up with the long, and having a defined risk, a much lower defined risk, really protects you from that. Because the gaps don't happen very often, but the odd time they do, all you'll do is take a very small loss on your position. Okay? So imagine for a second if there was some major news announcement like 9/11, for example, and overnight, this happened. The markets didn't open for a few days, and when they did, they were half their value. Well, if you own stocks, then your losses would be huge. If you own long options, you'd see all of them expire worthless, more than likely. The benefit of the debit spread is that each one of those positions would have much smaller exposure to the overall market, and your losses would not only be a lot smaller, but it'd be much easier to recover from. Okay, so let me try to bring up my TOS platform here. And I know they were going through some scheduled maintenance this morning. I wasn't aware of that before I came on, so it's going to look a little different, and we may not be able to navigate through, but we've got the Apple option chain up here, so we can look at some real numbers here. These are from Friday, so we can actually look at this. And let's say here we're looking at the November chain. Okay? And we think that Apple's going to make a move higher. Okay? Well, what you can do with a debit spread is, again, you can go in the money, you can go at the money, or you can go out of the money. And here are the key differences that I want to get across to you before we run out of time today. Is the deeper in the money you go, the higher your probability of profit. Okay? But the lower the less profit you are actually going to make. Okay, so let's look at an example. Okay, if, for example, we were going to buy the 90 strike here. Let's go 10 wide if we can, 90 and 100. Okay, so let's call this, it costs us 21, and let's call it 16 for easy math, okay? So by doing so, actually, those numbers wouldn't work out well, and we wouldn't have much of a gain there at all. Let's look at a different example here. Let's do the 90 and 95. So we're paying roughly 26, and we're collecting just slightly under 21 for the 90-95 call debit spread on Apple, and in the money option. So our strikes are 5 points wide here, but it's going to cost us about $4 for that position. Okay, foreign change. So what's our profit? Very little, right? Very little, because if Apple closes above that 95 strike on expiration, we're making the difference between what we paid and the difference in the strike prices, which will be somewhere between 50 cents and $1 here, not much. Okay, so we have much more risk on this way. We have about $4 of risk versus $1 of profit, because Apple can always move below that 90 strike by expiration. Right? That's always a possibility. So in the money, although it's a lot less likely that Apple will move below that 90 strike, when you do profit, your profit's much smaller. At the money, you're going to find you're going to have about a 1-to-1 risk-reward ratio most often. If you go one strike in the money, one strike out of the money. Okay. So for example, here, the difference between the 110 and the 115 is roughly about $3. Okay. on a $5 wide strike. So you're risking 3 to make 2. It's usually about 250 to 250. It's usually a 1-to-1. And the nice part about this, when you're going out of the money, is that risk reward scenario from the in the money is completely reversed. In other words, you will be risking about 50 cents to $1 out of the money to make 4 to 450 in profit. Okay? So if you're working with a strategy that is reliable and consistent and can predict these gains, now really all you need is a 1 out of 5 win rate to be profitable. Okay, on these, not very many. And trust me, we'll show you a strategy that is a lot more consistent than that. Okay, so basically, what you're doing here is you're buying a vertical. Okay? So you can see here, I'm going long 10 of the 110, and I'm selling 10 of the 115 strike. It's costing me $3.03 debit. Okay. Now, what do we do if it doesn't go our way? Because if it does go our way, hey, it's easy, no brainer. We're just going to bank a profit no matter what happens here. Okay? But what if Apple suddenly turns around on us and goes lower? What can we do? Okay? Now, first I want to make you aware, you don't have to go just one strike difference. You don't have to buy the very next strike. We can move this out and go even higher here. Let's see if, yeah, go to the 120, for example. Okay? 110, 120. You'll see now that, again, it's almost a 1-to-1 risk reward, right? Where it's costing us about 5, but it's a 10-point wide strike, giving us an opportunity to make 5 in profit. That's because I'm at the money here. Okay? But we can go even higher to increase that profit margin. Of course, you'll be increasing your risk as well. Now you can see if I go 110, 125, now it's costing me closer to $7. But I've got about $15 wide strikes. So 15 minus that 7 would be my profit. Okay? The reason why I'm showing you this is if you were to go, if you were to increase that spread between the strikes, when it comes to repairing a trade, as Apple starts to move lower, okay, you will quickly realize your full profit on your short strike, which you can close out and then resell a lower strike. Okay, go from the 125 to the 120, eventually close that out. Okay, bank that full profit, and then write the 115 against it. Okay, and you can do that all the way down. You can even turn this into a butterfly. Okay, unfortunately, I don't think I have the time to show you that right now, but that is even more enticing. I love turning these into butterflies. So let me just wrap this up. Give me one moment here. I'm just going to try to see if I can bring up a different screen for you here. Okay. There we go. All right. So we've talked about what a debit spread is and how you can use it, the benefits of it. Okay. The real key is when you use it, under what circumstances you use it, and how you not only structure it, but how you repair those trades. So I want to let you know about a pro class that we have coming up on our Mastering Debit Spreads class, which I'm not only going to cover the basics like I did today, I'm going to go into the advanced debit spread strategies that are going to further reduce your risk and increase your profitability. I'm also going to give you specific strategies that you can use 4 times a year, and we've got an earnings season coming up very soon, I'm going to show you specific strategies you can use to not only identify which stocks you can trade on earnings, but how to structure these trades with debit spreads. I'm going to give you powerful seasonal setups. You'll be able to fill your calendar with specific trades at different times of the year coming up that you can put these on. Again, remember the key with all these trades is minimal risk, okay, minimal risk. And I'm also going to teach you our favorite trade strategy that you can use to find the right equities that you want to trade this on. It actually works on stocks, options, futures, and Forex. So you'll be able to use it on all of them. And during this class, we will actually be doing a search for real-time trade setting up this week. The link for this class is tradingwins.com/debit. It happens Saturday, October 3rd. That's just next Saturday, 11 a.m. Eastern time. But let me tell you what you're going to get with this before you sign up so you know that it's right for you. You will get the live pro class that happens on October 3rd. It will be recorded as well, so if you can't make that date, you'll receive the recording. I will also teach you our favorite trade strategy. We'll go through several examples and search for trades. And as well, we're going to throw in a 30-day membership to our pro service. And this is a real benefit as well, because our pro membership is the best way to get access to all our systems. You will receive, as a pro member, nightly videos, our exclusive videos, recapping the markets. And I'm sorry. Oh, I'm sorry. I thought the audio blipped there for a second. You'll be receiving nightly videos from Sunday to Thursday evening. They're the best way to see how we trade using our specific strategies. We have several of them. You'll have access to our live market chats, which happen every Thursday morning from 10 a.m. to 11 a.m. Eastern. They are also recorded if you can't make that time, but they're great. You get to come into our room, ask me any trading-related question you like. They're recorded. You will receive at least 4 of those recordings during your 30-day membership as well. We've had some great sessions recently, especially with everything going on in the markets. And in addition to that, you'll have access to all our educational materials. There's hundreds of hours of video on our website that you can access and watch at your leisure. So you'll have access to all of that, which is normally a value of $541, but if you're on this webinar today, it's just $47. Again, it's tradingwins.com/debit, and we are making this available to the first 25 people. Okay, so this is everything you get. Again, I will go through the debit spreads along with the calendar spreads and diagonal spreads, all the repair strategies in full detail. I'll show you and share with you the specific strategies we use 4 times a year right around earnings season. I'm also going to show you seasonal setups that you can monitor and know exactly what time of the year is best to get in for each stock. In case you don't have your own strategy, I will teach you our favorite trade strategy, which has been consistent for well over a decade now, that you can use on stocks, options, futures, forex, any time frame. And together we're going to search for real trades, setting up for that coming week. Okay? Now, I'm not sure if we have any. We have a few more minutes. I think we have a few more minutes. I'm going to bring Raul in, our coaching coordinator. He's going to help me read off some questions so that we can get through a few here before we have to sign off. Raul?
Vince, we're going to have to go rapid fire on these. I've got a lot of questions and not enough time. We've got about 4 minutes.
Great.
Peter's first question is, hi Vince, always great to see you. I'm a current member. Is this a new course or is this something that you've offered before?
No, this is a brand new course. This is a brand new course I just put together this week based on everything happening in the markets to help not only our members but everyone else out there navigate their way through these risky markets.
Our friend Michael from Ottawa, remember him?
Yes.
He's saying,
Welcome.
Mr. Voracious, is this class okay for newbies?
Absolutely. It's fantastic for newbies. And you know, when you start out trading, what you really want to do is live to trade another day. You don't want to blow up your account. And most people start off with a small account. So this is not only great for small accounts, but it's a very consistent strategy you can employ that you know, has very little risk, so you won't blow out your account. It's perfect.
Marilyn's asking, are there cases where you can lose more than the premium?
No, absolutely not. There is not. And I will
John's,
show you why. I'll give you specific examples.
John's asking, does this work on weeklies?
It does.
How is-
And with weeklies, actually, the diagonal spreads are great. I'll show you a few of those as well.
Now, how has the options business changed since the weeklies came out in terms of using debit spread?
It has changed a lot, although, again, it's more the diagonals that you would use that for. But even, with some of the higher price stocks, and that's another benefit I may not have mentioned. How many people when they first start out with, say, a $2,000 account can trade the Googles, Amazons, price lines of the world? Well, now you can with this strategy. And those weekly options allow you to sell that premium over and over again, week after week, and bring in more money.
We keep mentioning stocks. A lot of folks on here are trading Forex, ETFs, etc. It works just as well. And those strategies...
Yeah, all the strategies work just the same, exactly. Setup is exactly the same.
Linda's asking, are there better times of the year to be trading debit spreads? Excuse me.
Well, there are specific times, more specifically, the earnings season, those seasonal setups. We will show you all of those, okay? But more importantly, we'll describe exactly when it's time to get into a stock, not only by showing you our favorite trade setup, but the best times volatility-wise that put the odds in your favor with debit spreads.
I'm being reminded that the link is in the chat box, tradingwins.com/debit, D-E-B-I-T, tradingwins.com/debit. Just go to the link. It's very easy to sign up. In the interest of full disclosure, what happens to your 30-day membership at the end of it?
Oh, thanks for bringing that up. At the end of the 30 days, if you're enjoying the membership, there's no need to do anything. It'll automatically renew at $97. But if for whatever reason you'd rather not continue, just give us a call before the 30 days are up, and we'll put a stop to it. It really is the world's easiest cancellation policy.
James, I see that you're having some trouble with the link. We'll correct that for you in the chat box. Just watch out for it there. What else did I have to ask him? Just looking through these questions.
I just want to answer a question from Jack. Jack is saying if you get a sign and your short expires, then you can lose more than you pay. No, you cannot, because you have your long option that is at that lower strike that allows you to buy and deliver that stock. So you can never lose more than what you pay for that debit spread.
Ken's asking, does this only work for specific stocks or securities?
Oh, no, you can use it on anything.
I'm sorry, I missed the one. Specific price stocks and securities.
No, and that's the beauty of it. Not only can you buy more contracts with a lower price stock, but you can also afford to trade Tesla, Google, Amazon, etc.
Brian is saying, thanks so much, Vince. Know how to trade debit spreads. Looking forward to the class on that. That actually helps me pick the underlying.
Excellent.
Vince, still more questions, but our time's up.
Debit, yes. And trust me, we're going to go through everything in detail. There's a lot of content here. My promise to you during that class is that I will stay as long as I have to answer all your questions. Our classes are always scheduled for 2 hours, but they typically go a lot longer, and I'll stay as long as I have to.
This is the first time we're doing it. It'll be fresh out of the oven.
Absolutely, and a perfect time of the year to do it.
At a perfect time of the year. It will have the pumpkin smell as well on the 3rd of October to have that fall kind of feeling. Hope you can join us.